Many business transactions are electronic, but many businesses also accept cash payments. There is no other asset that has a higher inherent risk for theft than cash. That is why it is so important to have strong internal controls in place to protect cash receipts and payments. Let's look at internal controls over cash processes. In order to prevent theft, businesses require a receipt for every transaction. This control creates an electronic paper trail of how much cash was received at the register. At any point, the actual cash on hand can be compared to the receipts record to see if they balance. Without receipts, a customer could buy the goods, and the cashier never rings up the order and just pockets the cash. If you ever see a fast food restaurant with a sign that says something like, "Your meal is free if you didn't get a receipt," you'll know this is why they are doing that, to make sure their cashiers are ringing up every order. Another internal control procedure businesses use is that the cash drawer is opened only when a transaction is entered. Cash is not kept on the counter out in the open but rather locked up in a register, and it's only opened when cash transactions occur. At the end of the day, the actual cash on hand is compared to the results from the register. One employee is responsible for preparing a deposit slip and taking the deposits to the bank. Separation of duties requires that someone else other than the person responsible for taking the money to the bank enters the sale receipts into an accounting system. Discrepancies between deposits and the accounting entry must be investigated. Cash receipts over the counter aren't the only ways companies receive money. Many businesses receive checks or cash from customers in the mail. The person receiving the cash should not be the same person who is recording customer payments into an accounting system. The cash and checks should go to a separate department or person than the remittance advice from the customer. At the end of the period, we perform a bank reconciliation to make sure the amounts deposited in the bank are the same as what was recorded in the cash ledger. Let's summarize. A receipt is required for every transaction, and the cash drawer should only be opened for a cash transaction. A person other than the person making the deposit should record the transaction in the accounting system. That's called separation of duties. For checks that are mailed to the business, the customer remittance advice should go to a different person than the one making the deposit. Periodically, but at least once a month, a bank reconciliation is performed. Discrepancies should be investigated.